Bitcoin, the bellwether for the crypto market, recently took a beating. Blame the stablecoins. Last week, Bitcoin hit a 52-week low, slumping to $25,402, a level not seen since December 2020. The digital gold has since rebounded, but at the time of this writing, it was still trading around $30,000. Crypto and equity markets have been selling off since the start of 2022, thanks to headwinds as varied as inflation, rising interest rates, and the war in Ukraine. Here is everything you need to know about the crypto crisis. First, what is cryptocurrency and how does it work? Cryptocurrency is a digital payment system that doesn't rely on banks to verify transactions. It's a peer-to-peer system that can enable anyone anywhere to send and receive payments. Instead of being physical money carried around and exchanged in the real world, cryptocurrency payments exist purely as digital entries to an online database describing specific transactions. When you transfer cryptocurrency funds, the transactions are recorded in a public ledger. Cryptocurrency is stored in digital wallets. The first cryptocurrency was Bitcoin, which was founded in 2009 and remains the best known today. Much of the interest in cryptocurrencies is to trade for profit, with speculators at times driving prices skyward. How does cryptocurrency work? Cryptocurrencies run on a distributed public ledger called blockchain, a record of all transactions updated and held by currency holders. Units of cryptocurrency are created through a process called mining. Users can also buy the currencies from brokers, then store and spend them using cryptographic wallets. If you own a cryptocurrency, you don't own anything tangible. What you own is a key that allows you to move a record or a unit of measure from one person to another without a trusted third party. Cryptocurrencies and applications of blockchain technology are still emerging in financial terms, and more uses are expected in the future. Transactions, including bonds, stocks, and other financial assets, could eventually be traded using the technology. Next, is cryptocurrency safe? Cryptocurrencies are usually built using blockchain technology. Blockchain describes the way transactions are recorded into blocks and timestamped. It's a fairly complex technical process, but the result is a digital ledger of cryptocurrency transactions that's hard for hackers to tamper with. In addition, transactions require a two-factor authentication process. While securities are in place, that does not mean cryptocurrencies are unhackable. Several high-dollar hacks have cost cryptocurrency startups heavily. Hackers hit Coincheck to the tune of $534 million and BitGrail for $195 million, making them two of the biggest cryptocurrency hacks of 2018. Unlike government-backed money, the value of virtual currencies is driven entirely by supply and demand. This can create wild swings that produce significant gains for investors or big losses. And cryptocurrency investments are subject to far less regulatory protection than traditional financial products like stocks, bonds, and mutual funds. How did the crypto market unravel? Like so many things, gradually, then all at once. Take Bitcoin, the original cryptocurrency, which is responsible for about a third of the value of the sector. The cost of a single Bitcoin has been dropping slowly since the end of March, alongside a broader malaise in the technology sector. That makes sense. An investment in Bitcoin is, in one regard, a bet on the possibility of further technological upheaval, just like the purchase of any other tech stock. With a rise in inflation choking off post-pandemic growth on both sides of the Atlantic, the whole sector began dropping. And then in early May, the dam broke. In a week, it dropped further than it had in the preceding month. The immediate cause was contagion from the catastrophic failure of another cryptocurrency project called Terra, which was once valued at more than $50 billion and ended the week effectively worthless. Terra collapsed in early May, wiping out the savings of retail investors. As Terra collapsed, so too did other cryptocurrencies. First, similar projects saw their values stumble as investors feared they would follow. Then the panic gripped the broader sector, and even comparatively blue-chip tokens, including Bitcoin itself, tumbled. It took until mid-May for the crash to stop, but while the market has regained some stability, it shows no sign of returning to anywhere near its highs of last month. We may be, in the words of one chief executive, heading into a crypto winter. That's the optimistic view from within the sector. The pessimists fear that this is the beginning of the end. Moving on, IMF head begs investors not to abandon crypto despite crash. People should not completely shun cryptocurrency after the recent collapse of a popular stablecoin, the head of the International Monetary Fund said on Monday. Tuesday, AEST, TerraUSD, or UST, imploded earlier this month, setting off a chain reaction that slashed the overall value of the cryptocurrency market by hundreds of billions of dollars. I would beg you not to pull out of the importance of this world, IMF Managing Director Kristalina Georgieva said at the World Economic Forum meeting in Davos. It offers us all faster service, much lower costs, and more inclusion, but only if we separate apples from oranges and bananas, she said, and that it was the responsibility of regulators across the globe to put up guardrails and offer education to protect investors. Ms. Georgieva said that there were many types of assets with varying levels of associated risk. For instance, there was a big difference between stablecoins that are backed by cash and other assets, and those that rely on algorithms to maintain their value, such as the TerraCoin, she said. Stablecoins are a type of cryptocurrency that are supposed to maintain a one-to-one value to a reserve asset, such as the US dollar. The less there is backing it, the more you should be prepared to take the risk of this thing blowing up in your face, Ms. Georgieva said. But she added that not all digital money should be tarnished with the same brush. Ms. Georgieva was speaking alongside other members of the world's financial elite on a panel discussing central bank digital currencies. Central Bank of France Governor François Villeroy de Gaulle dismissed concerns that central banks were slowly losing people's trust as cryptocurrencies and decentralized finance rose in popularity. My impression is more that in recent weeks, citizens have lost trust in crypto more than in central banks, Mr. Villeroy said, referring to Terra's collapse. Well, was that decline related to the turmoil in the regular economy? Probably. Tech stocks in general have been crushed in recent months, with high inflation undercutting the appeal of high-growth, low-profit investments, and a series of punishing revelations from the largest companies raising fundamental questions about the limits to their potential expansion. Bitcoin fans may promote an image of their currency as a sort of digital gold with a limited supply that makes it function as an effective hedge against inflation. But in practice, when inflation rises, Bitcoin tumbles, and as growth prospects diminish, so too does the opportunity for a digital revolution. On top of that, the crypto economy seems disproportionately driven by retail investors who treat the sector like a halfway house between conventional day trading, already a spectacularly risky way of investing cash, and straightforward gambling. As rising costs bite, those investors may be forced to liquidate some of their holdings, pushing the sector even further into the red. Finally, what happened to Terra to make it crumble? Terra was a project to make a stablecoin, a cryptocurrency token that has a fixed value of typically $1 US. Stablecoins are nothing new. Two of the most popular in the sector are called Tether and USDC, and they function effectively as banks. People hand them money, and they receive stablecoins in return, which can at any point be cashed in for money again. This reserve-backed model has issues, specifically that you have to trust the company behind the stablecoin to keep the money safe and easily accessible, and not put it all on red in Las Vegas in an attempt to make a quick profit with other people's cash. The biggest winners in all of this seem to be the corporate backers, venture capital funds, and successful startup. Just trust us is anathema to the cryptocurrency sector, and so there has long been a push for a new type of stablecoin, one that will keep its value algorithmically rather than through the action of bankers. Terra was one of those attempts, a pair of currencies, one of which, Luna, is supposed to float freely, while the other, Terra, is supposed to always have a value of $1. Luna can always be turned into Terra at a value of $1. So if the cost of Terra gets too high, Luna owners are incentivized to print more, and Terra can always be turned into Luna at a value of $1. So if the cost of Terra gets too low, Terra holders are incentivized to destroy the currency in order to raise its price. The problem is, the system only works if Luna has any value at all. For a while it did, thanks to an aggressive offer to pay 20% interest on savings held using the currency. And then, in the middle of the crash, as investors started to pull their money out to cover losses elsewhere, it suddenly didn't. That triggered what is called a death spiral, as investors turned Terra into Luna, which lowered the price of Luna, which meant that the next redemption lowered the price of Luna further, and so on. In a few weeks, the value of the Luna coin fell from $80 to around 1/1000th of a cent. The experiment was over. Unfortunately, that is all the time we had for today. Make sure to like and follow for more financial news. Till next time, cheers!